This video is a lecture from the Advanced Swing Trading Strategy course. Look at the description below to get the link of the full course. Welcome back, traders. In the previous lecture, you have learned about the demand and supply theory to understand how the trading markets really work and why demand and supply are the main force to execute the market. Now in this lecture today, I will be talking to you about the support and resistance level on a price action chart. At first, we will be talking about the support on a price action chart. Support is a specific price zone or area where the selling pressure becomes very weak because the supply of the market decreases as well as the demand increases, so that the buying pressure becomes stronger over the selling pressure and hence the price changes its direction to rise up from the support level. So after a bearish rally, if the price rises up by creating a valid bottom level, then that bottom level or swing low point becomes a support on that price action chart. The significance of this support level is that if again the market run into the bearish momentum and price falls down, then the possibilities are high that the price will retest the previous support level and then without breaking the previous support and falling further below that level, rather price will rise up again by creating another bottom or support level on the previous support zone. Supports are the price zone where we should look for the signal to trigger long trade entry. Now let's have a real chart example for these types of price action setup. As you can see, this is a 4-hour chart of Euro versus Japan Yen. Here you will notice that there's a price zone which was the lowest price level of the market for several times. From the top of this chart, price falls down until a specific price zone which we call as the support level. Then after hitting that support level, price rose up without breaking and going further below that support level. These support levels prevented the price to fall more down. The strength of a support level depends on the number of how many times the level was retested. As you can see in this chart, we have 3 support levels on one price zone. That means at least 3 times the price has been retested this zone and tried to break the level to bring the price more down, but it could not do that until the 4th attempt when finally price broke the support level and went further down. So this was a strong support zone for a very long time. Now you need to remember that a support is not an exact price level, rather it's a zone or area where the sellers tend to close their trades. In these levels, because of the lower price, the sellers psychologically become weak, so they start to close their trades, which increases the demand of the market and hence give the space to the buyers to go for long trade entries. That's why these are the area where you will find the best long trade opportunity in the market. So if you find any strong bullish reversal candlestick pattern in a support level like this, then you should go for long or buy trade entries, since possibilities are high that the market will move upward after that strong bullish candle from that support level, which will increase the chance to win that trade. Now let's discuss about the resistance on a price action chart. Resistance is the exact opposite thing of the support on a price action chart, while resistance is a price zone where the market tends to lose buying pressure because of the higher market price according to the theory of demand and supply. So because of the increasing supply or selling pressure, the price falls down after hitting the resistance zone. Basically, resistance are the swing high points or the top levels on a price action chart. So in general, whenever price comes near to the previous resistance zone, there are no demand can be seen in the market to show the buying pressure. So at that time, selling pressure becomes so strong that the price falls down after retesting the resistance level. This loop of the retesting the resistance level and then the price turning back again and again can be seen very often on a price action chart. But if the price can break the resistance level, then that would mean that the demand is still greater than the supply of the market, which drives the price to go more up. Now let me give you an example of this setup using real price action chart. As you can see, this is a day chart of Australian dollar versus US dollar. Here you will notice a resistance zone which has been retested for at least 3 times in this price action chart. Every time price reached this zone, the market declined to go more up. It shows that by the time price came near to the resistance zone, the supply volume becomes greater than the demand of the market, and hence that extreme selling pressure took control of the market over the buyers, with a larger volume of trades. So the resistance zone are the area where you will find the best signals to trigger short trade entry. That is why if you find any strong bearish reversal candlestick pattern in a resistance level like this, then you should go for short or sell trade entries, since possibilities are high that the market will move down after that strong bearish candle from that resistance level, which will increase the chance to win that trade. So that's the basic concept of the support and resistance levels on a price action chart. In the next lecture, I will show you more details about the support and resistance levels when these levels will be formed in a trendy market. So we'll see you in the next part of this lecture. Till then, have a nice day and goodbye. If you liked this video, then don't forget to subscribe the channel to get more educational videos like this in the future.